Good morning, all. Thank you for joining us this morning. Today, we will be hearing from Ron Shamgar, who is the head of Australian equity strategy at TAMIM, and also the portfolio manager for the Australian All Cap and Australian Small Cap Income funds. Clearly, it's been a really difficult start to the year across the portfolios, as well as the small mid cap Australian segment of the market. We thought it would be really opportune to sit down and talk with Ron today to understand exactly what's happened in the portfolio, go through it and dissect pretty much a number of the holdings that we have in there, and then the actions that we've taken across the portfolio, as well as our views looking forward over the next 12, 18 months for both the portfolio and the Australian equity segment of what we do. So with that, I might stop talking, hand across to Ron. Also, as per usual, if you have any questions, please just click on the Q&A button, should be at the bottom of your screen. Type in your questions and we will come back to them at the back end of the presentation and run through any of those answers for you. Thank you very much, Ron. Over to you.
Good morning, everyone. My name is Ron Shamgar. I'm head of the Australian equity strategy for the TAMIM All Cap Fund and the TAMIM Small Cap Income Fund. Today we'll run through this prezzo, just sort of talking about calendar year to date performance, what's happened, what's went wrong, and sort of how we addressing the situation, how we pivoted the portfolio, and why we think there's some really good upside over the next 6 and 12 months. If we flick through, just a quick disclaimer, obviously we're talking a lot about different companies, so none of this is financial advice. And this is, obviously about the Australian All Cap and the Small Cap Income Fund. So we'll give you an update on sort of what's been happening for the first 5 months of the year. Obviously, hasn't been a good start for the funds, and it's been quite tough in that sort of smaller end of the market generally, especially for the industrial part of the small cap market, which doesn't have exposure to any resources. We'll talk quite extensively about what went wrong and why we think a lot of these sort of positions that have hurt us could actually be some of our best performers in the next 12 months, because we don't think that anything fundamental has changed. It's just that we think that it's just short-term hiccups. And obviously, we've been through volatility in the past. We've been running these funds for 7.5 years, and we never sort of just do nothing and sort of stare at the lights and just hope that things will be okay. We're actually always quite proactive, and we change the portfolio to some extent, obviously following our fundamental investment process, but we do sort of adjust based on the conditions and where we see different thematics. We'll talk about our AI exposure in the fund. Obviously, the ASX doesn't have the same AI, pure play exposure like we have over in the US, but there's a lot of sort of the picks and shovels to the sector, and we've identified some really good opportunities. We've been building positions into these over the last couple of months, and we think they're going to do, some of them are already doing quite well for us, but I think they're going to do incredibly well in the next 12 months. We'll talk a bit about the Saspocalypse, this whole AI narrative has hurt a lot of the technology and software stocks, which has actually also hurt us, but why we actually remain quite constructive and we're sort of quite contrarian here, and there's some really good opportunities. And then we'll talk about a few takeovers and the portfolio stocks that are doing quite well. So what's been happening this year? The reality is that this year has been very tough if you're in the sort of investing in small and mid-cap industrial stocks. The actual indices haven't had a drawdown as much. They seem to be doing quite well. Obviously, in Australia, the index is made up of the large banks, which have done okay, and the large resource companies, which have actually benefited from this AI thematic, copper, lithium, and then we obviously have this energy crisis, which have benefited a lot of the miners. But beneath the surface, if you exclude resources, the small industrial index is really struggling. It's down approximately 17% from its highs in January, and it's been sort of driven by a lot of volatility. There's sort of four words that don't go well with small caps, and that's war, oil, inflation, and rate hikes. And we pretty much had all four of them happening over the last few months. So obviously we've had some, a lot of market headwinds, macro challenges. The war in Iran has driven oil prices up towards around that $100 a barrel, and that has really initially impacted inflation expectations, which has led to interest rate going up across the market, whereas before the market was expecting rate cuts in the US and potentially only one or two rate hikes in Australia. And then that, the high oil prices translated into high diesel and petrol prices, and has actually started sort of feeding through the economy into consumer spending. We've seen a real pullback. We've seen a pullback in travel, and also we've seen a huge sort of pullback in decision making by large companies. Everyone has taken a pause for a few months, so they're not signing contracts. If you're looking to build a new hospital, your costs have gone up, so maybe you're going to wait a few months and see what happens before you start digging. If you're going to sign a new contract to modernize your technology platform, you might take a pause for a few months and see what happens with the Iran war and all the uncertainty before you go and spend a lot of money. So we've seen that filter through to the actual sort of companies, and we've seen a lot of downgrades through the sector. In fact, around various industries, large caps, small caps, in healthcare, we've seen in software, we've seen it across the board. And not just in small caps. I mean, you've seen it even in some of the biggest companies on the ASX, like Cochlear and CSL and so on. And so that is obviously been feeding into elevated inflation numbers in Australia and the US. And that narrative has driven, in Australia, interest rate hikes. And as you recall, going back to 2022, when you get interest rates going up, it's a very negative sentiment for small caps. Small caps are highly sensitive to interest rate hikes, and also vice versa, and obviously for growth companies as well. So they've been hit quite hard, and if you combine that with sort of negative news flow or downgrades, and the market has been very, very unforgiving and very punishing for any company that delivers sort of bad news or a downgrade. In saying that, so we've seen that happen. The good news is that we're starting to see the end of that. Obviously, the Iran war has been in a pause over the last couple of months, and we believe that it's pretty obvious to see that Trump is trying to do everything he can to reach some sort of an agreement. We think that will happen eventually. That will flow on to oil prices and bring those down, and that will feed through the economy into improved spending, quicker decision making, and eventually into lower inflation. And that is really important because in Australia, the expectations were for 3 rate hikes this year. We've had 2. We probably have another one. But once we get through that, the market will start expecting sort of potential rate cuts in order to drive the economy better next year. And as you can see on the bottom right side, in terms of the Australia RBA cash rate market path, pre-April labor force release, which saw the unemployment numbers sort of creep up, the expectation was that we'll have rates sort of staying quite elevated until sort of mid next year. Whereas at the bottom part of the chart, the current one after that April labor force number, we're already expecting sort of potential rate cuts in the earlier part of next year. And that's really important because once the market starts sort of pricing that in and believing that, then I think you'll see the markets rally. And more importantly, small caps will really, really catch a lot of buying. And we've seen that sort of towards the end of 2022 and into early 2023. And we've saw a really strong market, and we performed extremely strong in that year and in the next 3 years. Obviously, this creates opportunities. So obviously, it has hurt us in the last few months. We've made some mistakes. So I would say that if you look at our drawdown across the 2 funds, I would say half of it is my fault, meaning we probably own businesses that disappointed more than we used to, and the other half was just general market sentiment and drawdown that it's hard to avoid when you're investing in small caps for the long term. But this leads to opportunities. If you look at the top right chart Aussie small caps, they're the cheapest they've ever been. If you look at the sort of valuation from a standard deviation, usually they trade at a couple points premium to the market, and now we're seeing them trading at a 3 to 4, less than the market is, which is pretty much cheapest they've ever been. This creates a lot of opportunities in oversold growth companies and a lot of neglected small industrials, maybe turnaround stories that the market is just not currently interested in, and we'll talk about some of them. And look, we are contrarian to some extent, so in these kind of volatile times, we tend to underperform. But we've proven that over time we come out really strong and we outperform over the long term, and we've shown that over the last 7.5 years, and especially in 2022, after we had a similarly kind of bad year, we came out and doubled investors' money over the next 3 years. So we're really confident that we're positioning the portfolio quite well to recover from this, and we'll talk about how we're doing it. But before we do, I think it's really important to understand what went wrong in the portfolios. And if you actually know what you own, you understand the issue, and you understand the businesses that you own, you can actually see that these are sort of short-term headwinds. And we think actually that some of these companies, although they've hurt our performance in the short term, they actually could be our biggest winners in the next 12 months. So the upside from here for some of these are quite significant. And in some cases, we've sort of reduced the position just to de-risk until we get more clarity. And in other cases, we actually think that the market is wrong and that the upside is quite significant. So in the month of February, which was quite a tough reporting month, we had sort of 3 disappointing news/downgrades. The first one is a company called ReadyTech. So they're a software-led business. It's a founder-led business that provides software into the Australian market for education, TAFEs, universities, government, in terms of councils, and then just workforce payroll software. They were quite confident and reaffirmed their guidance in November last year at the AGM, and they were expecting to win some large contracts in the TAFE market in Victoria, which got delayed. In February, they pretty much surprised everyone and downgraded, and the stock was punished quite heavily. Now, this company is owned by Pemba Private Equity for quite a while, and they own about 30%. And they had a takeover back in 2022, which didn't happen. And if you look at the business, we think that it's a really good business. It's probably got an elevated cost base, and we do think that they'll need to sort of make some changes within the business. But it's trading on sort of 12 times cash EBITDA, 1.5 times EV to ARR. So that company obviously disappointed and downgraded, but the business is a really good business. It's entrenched within its customer base, and most of its customers, they're either government owned, and they're not looking to build their own solution using AI tools. They're just looking for their tech vendor to provide them solutions, which is what ReadyTech is doing. Now, what's interesting is that since the beginning of this week on Monday, ReadyTech got a takeover offer at a 50% premium to the recent share price at $2. This is from a global software business that's a subsidiary of Constellation Group, which is one of the world's best software businesses. The board has currently rejected the offer. They believe the stock is worth more. We've met the management. We've actually had a meeting with the chair this morning. And look, we want the company to engage and look to sell the business. And we think that potentially you could see an improved offer over the next few months. So like I said, this company hurt our performance, but if a takeover does happen and they improve the performance over the next 12 months, it could be one of our biggest winners. Zip is another business, buy now, pay later business in Australia, but growing really fast, more than 40% in the US. One of the top sort of 4 players in the US. Had a consistent track record of always beating and upgrading over the last 6 reporting periods. And unfortunately, in Feb, they disappointed, and they sort of guided to a flat second half and first half, and the market was expecting them to grow. They also, the net debt position sort of slightly increased, and so the market panicked and smashed the stock by more than 50%. We sort of reduced the position, but we still think that the business, we understand the sort of short-term headwinds that they've had. They launched a new product, Pay in 8, which obviously sort of versus their current product which their previous product, which was paying for, sort of brought up that net debt position. But we think that this business can continue to grow strongly. It's trading on about 10 times cash EBITDA. It's very profitable. And in April, they kind of came out and sort of upgraded the expectations from February, and the stock sort of re-rated a bit higher. So we have a smaller position here. We are cautious, but we think that they can sort of get back to growing again. And if we'll start seeing sort of rate cuts in Australia, but more importantly in the US next year, I think this is the kind of stock that's highly sensitive to interest rate movements, and the stock could really sort of rip higher again. Another company that disappointed in February was AI Media. Now, this is a business, it's sort of it's a niche business in a niche industry, but it's a global leader. They provide live captioning and live voice translations in the US, Australia, and they're growing into Europe. It's a founder-led business. They own about 80% of the live broadcast market in the US. They've got these hardware encoders, which sort of sit within the broadcasters, and then they sell a layer of technology. They use a lot of AI and so on to give very accurate captioning and voice translation. The founder CEO, he's been buying shares on market. He owns 16, 17% of the business, and he was quite ambitious. He had this quite ambitious aspirational target for FY29. Now, the market, nobody believed those numbers, but it was sort of like a bit of a trajectory of where the business can get to. And he's delivered over the last couple of years a really good transformation of the business. Unfortunately, in February, they came out and sort of they downgraded some of the current year expectations, but more importantly, they sort of removed those aspirational targets. And they've also changed their business model a little bit from selling these encoders up front to a sort of more like a monthly recurring subscription revenue, which long term is quite good. But in the short term, obviously, it hits your top line. Obviously, the market sort of punished the stock quite aggressively, and it's currently trading at $40 million market cap. It's got 16 mil of net cash, so there's no debt, there's no balance sheet risk, and it's got at least $40 million of annual recurring revenue. And so, look, what we need to see is whether they can actually start selling these encoders on this new subscription model. We'll get an idea in August. If we can see there's traction and they're starting to sell these at what the numbers they expect, then we think that this business is actually really cheap, and we expect the stock to re-rate significantly. And if we don't see them executing, then I think we'll just exit our position and we'll just take the L. We reduce the position, so it's no longer a risk in the portfolio, but we still think there's significant upside, and it could potentially get acquired at a multiple of the current market cap. So it's one we're sort of watching, but it has been de-risked in the portfolio. And then in March there was no real news flow in the fund. Unfortunately, March was the second worst March in ASX history. ASX 200 was down 8%, and the small odds was down 10%. So unfortunately, although we had no news flow, we exposed to the market volatility, and we were down with the market. In April, we had one negative news flow, and that's EML payments. Obviously, EML, sort of a turnaround story. They're replatforming the business onto a new platform at the same time. They obviously fixed the problems of the past, and then there's been a change of management board and a lot of different executives. The new chair is a pretty impressive entrepreneur. He had a similar business. He grew it. He sold it for $900 million in 2021. And, he took over this business for the last year and a half. He's been turning it around, bringing his own people in. And I think even he sort of didn't realize that this transformation and this turnaround will just take longer. And obviously, we realize that as well now. And you can see that by the fact that he's bought with his own money $4.2 million of shares at sort of in the mid 80s. So he's down 50, 60% here. And obviously, he didn't buy this to lose money. He obviously bought this because he believed that he could really turn this around quicker than he thought, but that's not the case. So, if the insiders get it wrong, then obviously it's going to be difficult for us to get it right. I guess the downgrade in April was quite unexpected, especially after he bought more shares in March and they reaffirmed guidance at the end of Feb. But I think if you look at it, I don't think there's anything broken here. I think it's just that the turnaround and the time to turn it around will just move to the right by 12 months. half of the downgrade was related to contracts that they've won and signed, but they're not going to launch before June 30. They'll just launch in the first half of 27. So that's not lost revenue. It's just revenue that's been pushed to the right. And then the other half is they do have some gift card exposure in Europe. And obviously, with the Iran war in March and April and consumer spending sort of pulling back, we've seen that impact them. And so that was sort of the reason for the downgrades. Now, if you assume that consumer spending will come back to historical levels in 12 months from now, and you believe that those contracts that they've won and signed will launch next year, the next year should be a good year. And then at the same time, they're continuing to build the new business pipeline and convert. And so I think that, the thesis is still intact for now. We obviously resize the position because we always do after bad news, but we still think there's significant upside, and we will reassess in August and then decide whether we want to add more or not. It's currently trading on 4 times EV to EBITDA. We don't think they have a balance sheet issue. And we think that we've met the management, the exec chair, many times over the last few months, and we think that he will deliver. They are launching a new vertical in mobility, which is fuel cards. They've got the customers already in the salary packaging segment of their business, and so when they launch that in the next 12 months, that could be a significant earnings driver as well. So we're going to watch that. And then in May, we've had 2 quite disappointing news flow, which was sort of unexpected. The first one is Gentrack. That's been a core position for us since 2022. We bought it back then at $1.50. It's consistently outperformed expectations, upgraded, and sort of went up to sort of $9-10 at the end of last year. Impressive management team. It's a billing software for utilities. So if you think about when you get your bill from Origin Energy or AGL or whatever, that's them behind the scenes providing that technology. And obviously they're doing it all over Europe, the UK, Australia, New Zealand. They also have airport software in over 160 airports around the world. So when you land in an airport and it tells you which gate to go to, where to pick up your baggage and so on, that's all Gentrack in the background. And so it's a really, really good business, probably one of only 3 or 4 global companies outside the US doing it on a scale basis. Again, in May, unfortunately, they provided a downgrade to the market, which was unexpected. They told the market that they had 10 contracts in the pipeline in November last year, which they believed they will convert at least 2 or 3 of those during this year, which will drive significant growth. Just to give you an idea, this business, after the downgrade, is making $240 million of revenue per year, $20 million of profit before tax. It's got $40 million of net cash on the balance sheet. So it's a really profitable cashed-out business. This pipeline of 10 contracts is valued at $400 million. So it's significant. If they can win 2 or 3 of those, then it's quite significant for their growth. Now, what they're saying is that there's been delayed decisions to a couple of these contracts, which they expected to win by April and May. The first, we've seen this across the board. We've seen, as I said, a lot of large kind of companies taking a pause and just delaying decisions in terms of signing contracts. And so we don't believe that this is an excuse. We've seen this across the board since the Iran war began. But they don't believe that this is lost contracts. They just think that it moved to the right by approximately 3 months. So we expect them to convert this over the next 6 months. And if they do, we think the stock could double or triple. Again, great business, sticky revenue base, and there's a huge tailwind as all these utilities around the world have to upgrade their billing software. It's all legacy software. And so there's going to be huge demand over the next 10 years. We've seen some other companies doing really well, like Kraken. And so we think Gentrack will continue to do well. We see this as a short-term hiccup. Now, if the stock stays at the current level, which is about $330 million market cap, we think there's potential that it might get an opportunistic takeover offer. And if they win these contracts, then obviously we think the stock can get back to its highs over the next 12 months. And so we don't believe there's anything fundamentally broken here, and there's quite significant upside. The last one was Tua, which was probably one of those unforeseen kind of events that the chances of them happening are quite low, but it did happen. So Tua is a mobile telco business in Singapore under the brand of Simba. It's led by the legendary founder David Teo. He founded TPG Telecom. He grew it to, the beast that it is today, and eventually merged it with Vodafone and exited that business. As part of that transaction, he spun off this little company called Tua. They started with nothing 6 years ago in Singapore, and they basically went about to disrupt the mobile market in Singapore by offering cheap prices, just like he did with TPG Telecom and the internet market about 15 years ago. Over the last 6 years, he grew the business to about 12% market share, making $100 million of EBITDA per year. And the stock was an ASX 200 business, spitting cash. And then about a year ago, there's three big players in Singapore: Singtel, StarHub, M1, and Simba. M1 was being sold, and Simba signed an agreement a year ago to acquire M1. And as part of that transaction, he raised money, and there was a regulatory process to get approval. Now, that process has obviously delayed into this year. And then in May, the company announced that the regulator was suspending the review of the transaction because of potential breaches of Simba's spectrum use in Singapore. Now, obviously, this was something that was completely unexpected by the market, and the stock was smashed on the day by 65%. We're talking about a ASX 200 business. Now, I guess you have to ask yourself, the current market cap is $1.1 billion. It's got $500 million of net cash, no debt, and it's a business that's growing at 25% per annum, making 100 mil of EBITDA. Now, David Teo, as the largest shareholder with his track record, they're very conservative, entrepreneur. We don't believe that he would do anything intentional or try and run a fraudulent spectrum operation in the one country that you probably don't want to do it, which is Singapore. We think that most likely it was some sort of a equipment malfunction that was unintentional. And we believe that it was probably leaked to the regulator by one of its largest competitor, which is actually government owned, like Singtel and StarHub. Because if Simba were to acquire M1, then it will make Tua a formidable opponent that will continue to disrupt other segments of the market. And that's the last thing these guys want. So, unfortunately, this deal is not going to go ahead. And the market is essentially saying that there's a risk of Simba losing their spectrum, which means that the business will be at risk. And that's why the stock is trading where it is today. Now, the bet here is whether you believe David Tua, and if you believe that this was a sort of an equipment malfunction, if it was unintentional, they probably get away with a fine and move on. And if that's the case, then the stock will double. And obviously, there's other scenarios. And the worst case scenario is they lose the spectrum, which means that Singaporean mobile users will see increased prices, and the only true sort of market disruptor will go out of business. In that case, the stock is probably worth, if you take the cash, the equipment and capex, and if you take the subscriber base, it's probably worth about $1.50, and it's currently trading around $2. So we think the market is pricing like a very worse outcome, and we think that that's not going to be the case. So we think that once there'll be more information available to the market, because they've been very, very tight-lipped about what's going on, then we think the stock could easily double from here. And we'll see how that played out. But that was unfortunately very unexpected type of news. So that's kind of what went wrong. So what are we doing about this? Obviously, we're looking at sort of portfolio repositioning, meaning, first of all, active risk management. So when we go through these type of drawdowns and difficult sort of periods, we do a comprehensive review of every position in the portfolio and the underlying fundamental thesis. We're trying to see whether there's any positions that, obviously, with economic uncertainty and things have changed over the last few months, are there any other companies that we can anticipate where there's some earnings risk? And if we found those positions, then we look to reduce them or potentially even exit them. We're also just in general lowering the maximum position size limits across the portfolio. So, obviously in these kind of uncertain times of volatility, you don't want to have, too much in any one position, because as you can see, you can have the most unexpected type of risks just creep up on you. And we've increased the cash in the position to what is historically quite high for us. So around 15% cash is generally quite high. We usually at that sort of 5 to 10%. range. And then at the same time, we're not just sitting there and doing nothing. We've repositioned the portfolio towards sectors that we think are less exposed to the current economic cycle, and we'll talk about some of those. And I think it's very important to understand that, I've been doing this for 23 years, but you always have to learn and try and improve. And so, one thing that we've realized is that turnarounds always take longer than you think. Doesn't matter, who are the execs, and doesn't matter how much they're buying shares on market. I think you have to position, size it, and wait for the turnaround to really kind of show you the fruits of those turnaround, and so you can build that position into that. And also, I think that the one thing that has hurt us is, we've got some exposure to software and technology companies, and we've had this whole SaaSpocalypse thematic where AI is going to disrupt these businesses. We don't believe that's the case, but that doesn't matter because the market has, has kind of has sold off those positions quite aggressively, and that has hurt us, although the fundamentals of these businesses haven't changed. And so I think that what we need to do is sort of, when we see a sector that's facing a significant negative sentiment, we don't need to exit those stocks, but we just need to look to sort of just reduce across the board, regardless of the fundamentals. And once there's a bit more certainty, then we can add back into those positions. So in terms of the strategic shift in the funds, what we've done is sort of, we look to increase exposure to stocks with strong AI tailwinds. Now, as I've explained, we don't really have on the ASX the Nvidias and Googles and all those real, pure play AI companies here, but we do have a lot of the sort of picks and shovels plays into the sector. And we've identified, it took us a couple of months to sort of realize which ones are going to do well. And we've identified the ones that are going to do quite well from the data center build out that's happening in Australia. And then a few other ones that sort of provide services, equipment, and so on into that sector. And actually some that are global businesses offering services as well. We'll talk about those. And then we're just looking at just favoring companies that are benefiting from, obviously there's been a lot of tax changes with the government and the budget. And we sort of position some companies that are going to benefit from, whether it's different tax structures like investment bonds or electric vehicles. And there's some new regulatory certainty in terms of the FBT discounts and so on. And so some of these companies are going to do quite well now that there's regulatory certainty for the next couple of years. So AI exposure. So I think we really want to, focus on infrastructure enablers rather than pure AI application risk. So, targeting companies that are providing essential services to this AI growth. On the ASX, it's essentially contractors and equipment providers to the data center sector. We're seeing sort of this insane amount of data centers being built. And for the next 5 to 10 years, we think that will continue. And then, we have a couple of data center operators on the ASX and related infrastructure. Some of them are expensive, but some of them actually are not bad. And so there are sort of selected positions that we've added on. For example, Macquarie Telecom, which is a data center provider, which we think is quite well priced, founder-led business. HMC Capital is an interesting one. It's actually an investment manager that actually owns positions in data centers and renewable energy, which was going to be very important for data centers to build. They'll have to have their own supply of renewable energy. And so that business, again, is founder-led, and I think is going to perform quite well with this sector. Megaport is probably the best pure play AI exposure we have currently on the ASX. The stock is doing extremely well at the moment, and we've actually written an article about it yesterday. So if you really want to understand this business, we try to kind of simplify and explain what it is. And essentially, it's kind of like a similar version to Firmus and all those guys. The difference is that they've got a networking business, an existing networking business that makes about 300 mil revenue, is very profitable in about 1,100 data centers around the world. But what they've done is that they've gone into providing computing power to all these AI, large language models and companies. And what they can do is, instead of when you're doing training, you need a lot of you consume a lot of power, and you need a lot of power in big data centers, which is what the thermoses of the world and CoreWeaves do. These guys do it for inference, which requires less power, less cooling, and can actually be spread across different data centers around the world. So over the last 6 weeks, Megaport in that new sector of theirs, new division, they've won $750 million of new contracts, which is insane. Obviously, it's a very capital intensive business as they need to buy these NVIDIA chips and so on. But once they do, they've got these contracts which are highly profitable and pay back within 18 to 24 months. So we think that this business is going to do extremely well. They just did an equity raise this week, and we're already up on it this month, but we think it's going to continue to grow, and it's probably one of the best exposures. Appen also provides a lot of services to these LLMs and helping them train data. And then we have some of the contractors like Simul. It's a founder-led business, and they are sort of a contractor to building data centers and infrastructure and renewable energy. They're also going to do quite well with the Queensland Olympics and the build up there. So those are the kind of exposures that we have in terms of the picks and shovels strategy. In terms of the Suspocalypse, the software sector was really sold off over the last 6 months. The tech index was down 35-40% from November to about April. We've seen a little bit of a recovery in the last few weeks. Now, we believe that AI is actually going to be a powerful long-term growth accelerator for SaaS companies that actually embrace it. We don't believe that companies are going to internally sort of vibe code and build their own applications. It is expensive, and you do need a lot of domain expertise and know what you're doing. And that client stickiness of existing companies is quite hard to displace. And so new entrants, yes, they can build software more cheaply and quickly, but there's a difference between that and actually selling it into large organizations and getting you to trust you, and then the process of switching over from an incumbent provider. So we think that the companies that will embrace AI and offer all those features to their customers will continue to do well, and in fact not only grow faster, but it will be able to also reduce their cost base. So the market has been very punishing on these stocks, but we think that over the next 12 months, that narrative will start changing. And it's a little bit, if you go back to the 1990s with e-commerce and the internet, all the bricks and mortar retailers got heavily sold off because e-commerce was going to kill all of them. But 20 years later, some of the biggest e-commerce online businesses are actually part of the bricks and mortar physical retailers. And it's hard to find a pure play e-commerce business actually making much money. Obviously, if you exclude Amazon on the side. So we think this is a similar situation, and eventually, there will be some losers, companies that don't adapt, but we think the majority are going to do quite well. And we took this opportunity. Obviously, we've owned a few positions like Gentrack and Bravura and so on, but we finally bought 2 companies that we've been waiting for a while to own. So Promedicus, probably one of the highest quality businesses in the entire world. We're talking 70-80% profit margins, which is unheard of, growing at 30% per year. They own about 10% of the radiology market in the US in terms of providing software. And they continue to win contracts. And more importantly, they're renewing contracts at higher prices. So it not only shows that they have customer stickiness, but they actually have pricing power. We finally got to buy this business after many years trading on 200 to 300 times PE multiple. It finally got to sort of mid 60s, which we think is really cheap for this kind of business, growing at 30%. And it's actually doing quite well at the moment. And then the other one is SiteMinder, which got sold off because of the Suspocalypse narrative. And obviously, it does provide middleware software for hotels around the world to help them sort of sell their rooms on travel sites like booking.com and so on. And they've been sold off, obviously, with this whole sentiment in terms of travel. But we think that this is a really, really good business, growing at 30% per annum. And it's on that inflection point of actually starting to generate cash and profits this year. And so we bought that, and it's actually started to re-rate quite nicely. So we think that a lot of these software companies have underperformed, but we think they'll be some of the biggest winners over the next 12 months. So, obviously, as we've seen back in 2022, after a huge drawdown, there was a lot of takeover activity through mid 2022 and into sort of 2023, and we benefited from that. We're starting to see that happening. There's a couple of companies in the portfolios that could see potential near-term takeovers. So the first one is OFX. So that's a global payments business. It's generating it turns over almost $40 billion of transactions a year. It's got 30,000 corporate clients around the world, mostly North America, APAC, and some in Europe. And they've got about 100,000 consumer clients transacting on it. Now they've been going through this, sort of like updating, modernizing their tech platform over the last couple of years, which obviously they had to invest a lot of money. They've pretty much come to the end of that. So there's a significant cost out opportunity. They've cashed up. They've got about $50 million of net cash, and after debt is about $32 million. And so they're trading on about 4 times EBITDA. The stock has really been punished over the last few years. It hasn't performed. We took a position sort of early this year, and in early February, the board initiated a strategic review to maximize shareholder value. Essentially, they got a few offers late last year. They saw that it was pretty serious, and so they appointed Goldman Sachs as an advisor in early Feb to actually try and run a proper process and try and get the best possible outcome. They've had multiple interested parties in the initial DD phase, which then they got non-binding offers to take them to the final phase, and which they're going through now. They told the market that there's a few parties in the data room that are serious and credible, and that they expect an outcome before 30th of June, which is in the next 3 to 4 weeks. We believe that the market, they're currently trading on about 130 mil market cap with 30-40 mil of net cash, profitable. But we think that this business has 3 very attractive, sort of valuable assets that the market is sort of maybe misunderstanding or undervaluing. The first one is the technology platform, which a lot of these larger players have legacy technology stacks, which they can use this platform to transition their own customers. Obviously, the customer base of OFX is really attractive, and you can buy that and move it onto your own platform and eliminate a lot of cost. And then the global sort of licenses, banking licenses that they have all over the US, in different states, in APAC, Australia, and so on, is actually very valuable. And many companies don't have that and can take 3 to 5 years to get that. So depending who's looking to buy them, each different player might value different parts of the business more or less. So look, this could be a standard 30% type of takeover premium, and it could also end up being 100% if there's a bit of a bidding tension. So we'll wait and see. The other one is Hum Group. There's been a bit of activist shareholders there. The chairman sort of got voted out. Credit Corp made an offer in the mid 70s to acquire them. They're going through a due diligence process, and the stock is obviously trading on about 7 times PE, pays a yield. It's got a net tangible assets of 80 plus cents. It's trading around sort of 58 cents or so, and so we think that Credit Corp does want this business, and we think that if a takeover eventuates in the next few weeks, there's potential there for 30-40% upside. And obviously, as I was doing this preso, we had 2 takeover offers in the funds. One was Tourism Holdings at a 50% premium. That was in a small cap income fund. And then obviously ReadyTech this week, a $2 offer at a 50% premium, which was obviously rejected, but I think that's going to play out and we might get a higher offer. So it shows that we're starting to see this takeover activity happening, and we expect a lot more now that there's more certainty in terms of the Iran war and all the other risk and AI and everything. I think bidders are getting more confident, and that you're going to see a lot of offers come in the next few months. So just before I finish this, I'll just talk about 3 core holdings that we've either owned in the last few months or we've been building position in. And these are really good businesses that are going to do quite well, irrespective of the current economic cycle. So Cascal, that's an infrastructure B2B payments business. It listed only about a year and a half ago, and it provides basically all the sort of payment rails to a lot of the banks in Australia, credit unions, fintechs, and so on. It's been acquiring some of its competitors in Australia in terms of Inju, and in New Zealand, Paymark, similar businesses to them. And what they're doing is essentially, as the contracts roll off within these businesses, they're bringing on those contracts onto their own platform, and they'll be able to extract a lot of cost outs from these acquisitions. So the company, just from integrating these acquisitions over the next 3 years and taking cost outs without even any growth, will double their earnings over the next 3 years. So they'll go from 20 something cents to about 40 something cents of EPS. Plus, obviously, they'll have growth, and obviously they'll do some more acquisitions. So this is a business that we think will probably double in the next 2 years, and it's a very defensive business and should do really well. The other one is Servcorp. So Servcorp, one of the biggest, if not the biggest, service office provider in the world, founder-led business. We bought that 3 years ago. It's done really well for us, about three and a half times our money with dividends. It's got a bulletproof balance sheet, 140 mil of net cash, so more than 20% of the market cap. The founder owns 53%. He keeps buying shares on market. And basically what's happened is that they've been doing extremely well in the Middle East, in Saudi and so on. The Iran war obviously has sort of, saw the stock kind of pull back 20-25% in the last couple of months. But, a lot of those tenants in their Middle East offices are actually government tenants. And so they continue to pay the rent. And that creates a really good buying opportunity for a business that has a really long-term track record of growth, cashed up, pays dividend. And I think once this war completely ends, the stock will re-rate significantly higher. And then the last one is, I mentioned it before, but CMAL, it's really one of the few contractors that haven't really kind of re-rated in the last few months. A lot of the other contractors have done really well as they've been buying sort of more electrical contracting businesses that service the data center market. It's a founder-led business. The founder owns 70%. They've been growing organically and acquiring businesses and integrating those businesses and bringing the founder of these businesses into the group. And we really like what the founder is doing. I think they're going to win a lot of contracts in that sort of digital infrastructure, energy, defense market, and obviously in Queensland with the Olympics and all that spend that's coming. They're profitable, and they've got an ambition to sort of grow their earnings to 200 mil by 2030, but I reckon they'll do it a lot sooner. And we think that once they do some acquisitions in that sort of electrical part of the market that services data centers, the stock will re-rate significantly. It's trading at half the multiple of all the other contractors that are doing exactly the same thing. So we think the upside is significant here, and they've got a good balance sheet with minimal debt. And yeah, so the last slide before we go into Q&A is just, let's take if we kind of step back and we take a big picture view. This is the all cap fund chart at the light blue color. If you look up until the end of last year, 7-year track record doing about 17.5% per annum net of fees. And obviously over the time we've had some drawdowns. If you go back to 2019 when I joined, we had a great year. Then obviously COVID came. That was markets capitulated. We recovered. We pivoted. We did extremely well for the next 3 years, 2020, 21. 2022 was that difficult bear market, and obviously we had a tough time. But again, we didn't just sit still. We pivoted the portfolio to what we saw is going to do well, and we doubled investors' money over the following 3 years. 2023 was really strong. 24 was really strong. 25 was really good. And this year also, again, we're seeing a drawdown for the reasons that I've explained. But this is a cycle. And like I said, we position the portfolio to benefit, and a lot of the stocks that have disappointed will recover and will probably be our biggest winners or will get taken over. And so investors that either persevered and were patient in 2022 were rewarded over the next 3 years. And at the same time now, I think investors that will be patient or even reinvest at the moment will actually do well for the next 3 years, because the investment process and our investment fundamentals have not changed. And we've shown that we're able to take these drawdowns and continue to perform. And so that's kind of the picture and the thought I want to leave you with today. And with that, we can go into Q&A.
Ron, thanks. Not a fortune of questions here. I think you were pretty comprehensive and covered off a significant amount of information. The one question that I have got for you is regarding MP1. and just wanting to know if that is held in the all cap portfolio, the small cap portfolio, or both. Where does that get held, and what's the reasoning if it's held in different portfolios?
Yep. So Megaport is held in the all cap portfolio. Obviously, if you recall, the small cap portfolio, the mandate is a little bit less flexible, meaning that the majority of the companies have to pay some sort of a dividend or have a capital management aspect to their business. And also, we are more restricted that the majority of companies have to be around that billion-dollar market cap or less. So Megaport is obviously significantly bigger, and they don't pay dividends at this stage. So that particular company is in the all cap fund, but some of the other ones are actually also in the small cap income fund.
Thanks, Ron. Just one closing question. I'm not sure if you've got the data in front of you there. Just in terms of the conversation and your last slide, you'd shown the all cap. Obviously, small cap income is a second portfolio that you operate as well. How's that gone through the last 12 months that you've seen the tougher period through on the all cap as well?
Yep. Look, the small cap income fund has had a less of a drawdown this year. In fact, historically, it's always had it's been a less volatile fund, but it's also just not performed as strongly as the all cap fund. And the main reason for that is that it's the mandate. The all cap fund can invest in growth companies, turnaround stories, and so obviously companies that are not paying dividends or have capital management. And so if you get those right, they tend to outperform and grow a lot quicker than companies that are maybe more established and pay dividends. But also on the flip side, it doesn't have that, it doesn't get impacted as much when times are volatile. But over time, they both performed really well. And if you look at the last 7 years up until beginning of this year, the all cap was doing 17.5% per annum net of fees, and the small cap was doing around 14%. So we always tell investors to sort of hedge their bets and spread across both funds, because some years this one does better, some years that one does better, but they both perform. And sort of, yeah, so the small cap, if you take this year, it's down a lot less than the all cap. And over the last 12 months, because of that, it's actually done better. But we always tell investors you have some in that, and over time they both do really well for you. And if you look at, like I said, the all cap fund after 2022, it was up 26% per annum, doubled investors' money. The small cap income fund was down less in 2022, but it still performed well and did almost 18% per annum in those next 3 years after 2022. So we expect similar performances over the next few years.
Thanks, Ron. Yeah, so just to sort of clarify that as well, over the last 12 months, small cap income up 14%. So yeah, it's been a tougher environment in that small mid cap Australian equity market, but the small cap income actually held up relatively well through that period. Just one last one coming back to MP1, and I'm not sure if you're happy to disclose this, but just questions around what your position sizing is on that, and maybe that just segues into a broader question. Where are you looking at sizing your positions in the portfolio at the moment?
Yep. Look, we don't disclose sort of position sizing at a point in time, because obviously that changes, and we may be buying more or we may be taking profits. They're actually also doing an entitlement offer, which is obviously at a significant discount to what the current share price is. So we'll decide whether we want to participate in that, depending on the share price over the next 2-3 weeks. And obviously, if we do, then that will increase our position. I think we have a really good balance now in the fund in terms of, we've got software technology exposure where we're being contrarian because of this whole apocalypse. Then we've got this exposure to these AI stocks where some of them we're still building positions into. And then there's other positions that I haven't spoken about, which we're quite excited about, which have significant upside, but we're not ready to disclose, but we will in the next few months. And so, we're being cautious, and you don't want, I don't think any investor want us to just, spend all our bullets and build our position within a week. We want to take advantage of this market and this volatility and build into positions over 2, 3, 4 months. And as the market recovers, then we're going to do well. Now, if a position starts running, that's great. We're making money, and we might sort of average up. And on the flip side, if a position is so continuing to being sold off, but nothing has changed, then that's great. We're going to sort of average down. And so that's what we're doing. So yeah, I think look, Megaport is going to do really well. Obviously, it's going to be a little bit volatile in the short term because they raised a lot of money this week. So there's going to be some profit taking, but I think they're going to continue to win a lot of these contracts. And as they perform, and if we take up our entitlement offer, then it could actually be a really good position for us. And as I said, we reduced general position sizing across the portfolio, but still we have positions that are sort of 3, 4, 5% of the fund. And as the uncertainty around the world sort of settles down, then we can build up conviction into higher conviction in some other stocks as we get more confidence and these businesses sort of execute and show us that we can trust them.
Ron, thank you for that. There don't seem to be any further questions on the Q&A panel. Having said that, if there's anything that you feel you would like to clarify or ask, please reach in to myself, Jeff, to Sid, or to Ben, and Ron as well. We're always happy to take your calls and talk to you about what is happening in the portfolio. We thank you very much for your support and your time today, and we look forward to talking again over the next few months. Thank you.